Good afternoon, everyone, and welcome to JMT's Expert Speaker Series. We're going to wait another minute to get started because we still have some people logging on, so just bear with us and we'll be right back. Okay, once again, thank you for joining JMT Consulting for our Expert Speaker Series. We're happy to have Russ Pomeranz, President and CEO of the Claverack Advisory Group, presenting today on nonprofit finance committees, what they're doing well, where they need to improve, and why it matters to the mission. This webinar is sponsored by JMT Consulting. We are an ERP and financial management solutions firm with 27 years experience, and we specialize in nonprofits. We work with a wide variety of software partners to find the best solution for your nonprofit. I'd like to share a few housekeeping notes and then I'll turn it over to Russ. If you have any questions during the webinar, please submit your question in the questions box on your control panel. We will answer questions at the end of the webinar. You will also receive a survey at the end of the webinar to tell us how we did today. Finally, this webinar is being recorded and the slides and the recording will be sent to you tomorrow. Lastly, I'd like to introduce Russ Pomeranz. Russ has 30 years of experience connecting nonprofit mission to financial sustainability. While currently President and CEO of the Claverack Advisory Group, a consulting firm, Russ learned from his experience as COO, CFO of the Vera Institute of Justice, Director of Finance at the Council of Foreign Relations, CFO at Sense Chapin Services to Families, and Children and Business Manager at the Merit School, where he also taught geometry. We're happy to have him with us today, and with that, I'll hand it over to Russ.
Great. Thank you so much, Melissa, and to JMT for the opportunity to discuss nonprofit finance committees, their role, importance, and how everyone works together. I've been drawn to this topic as I've seen the role of nonprofit finance committees taken on greater significance in organizational mission fulfillment and financial sustainability. Not only do they have the traditional obligation to preserve the organization's financial resources, but in this hyper-competitive and strategic age, nonprofit finance committees must play a motivated role to drive nonprofits forward. Finance committees living in the reactive past risk mission irrelevance or more excruciating consignment to the treadmill of limited financial resources. Finance committee decisions working with proactive finance teams and leadership result in thoughtful, necessary mission investment to achieve sustainability while maintaining maximum societal impact. This just isn't an academic exercise. My experience, and more importantly, the experience of many others who have spent time in the belly of the beast, including CEOs, CFOs, and finance committee members, have shared similar experiences connecting finance committees to organizational rejuvenation, startup success, and again, the drive forward. CEO longevity is now as much a function of an organization's financial position, track record of unrestricted bottom line results, and long-term business model viability as it is clarity of their programmatic vision and priority. It is not unusual for CEOs and CFOs to suffer the finance committee breathing down their neck, even to panicking if management can't explain their short-term cash and long-term financial positions. I'm sure many of you have experienced this. CFOs who also can't explain the organization's financial position and are siloed from programmatic revenue-producing allies also find their job is at risk. Likewise, finance committees can no longer pass the financial distress blame onto everyone else. They must be responsible for the long-term financial strategic success of the nonprofit. However, on the plus side, those finance committees who contribute to building a sustainable business model based on forward-looking financial decisions and goals can take proud, undeniable, and great credit for their achievements. I've been CFO of organizations such as the Vera Institute of Justice, Council on Foreign Relations, Defense, Chapin Services to Families and Children, but I've also been chair of the finance committees on numerous other organizations, including JobPath, WPTI, and the Columbia County Historical Society. I have lived on both sides of the aisle. As a consultant, I've worked with finance departments, CEOs, finance committees, and boards. On an emotional level, the hypothesis that finance committees are key to mission success is also based not only on experience, but tales of anguish, loss of sleep, disappointment when mission opportunities are lost, painful contingencies, wasteful transactional reporting that becomes a burden, and ultimately budgetary battles that lose sight of the nonprofit's mission aspirations. I thought about how to structure this presentation to be of greatest value to all constituencies. At first, I kept thinking about an us versus them approach, finance committee versus financial management. This is often the adversarial dynamic both sides have to live through. At times, it can be win-win, not necessarily a zero-sum game if people listen to each other and respect each other. At times, it is a lose-lose proposition when no common ground is found. As I thought about it harder, both the finance committee and financial management are part of the same team. I focus on how members of the team have to learn how to work together in order to achieve common goals, including mission, strategic, administrative, and financial. Everyone on the team has defined roles, should support each other, should look for a consensus, yet ask the difficult questions and make the tough short and long-term decisions that result in positive, programmatic, and financial returns. From my experience, it is critical that the finance committee and organizational financial management treat each other with just respect and humanity. Everyone must also respect the nonprofit business model, a critical and rational corporate business structure that demands everyone's attention for its unique capacity to achieve and impact all-important societal missions. I find that is really important as we go through this process and understand the relationship between the finance committee and financial management. Obviously, a lot is at stake. The initial slide here shows the two ends of the finance committee relevance continuum as dramatically as we could think of. Soaring into the mission sky is the positive outcome. Staring into the financial abyss is the 180-degree opposite outcome. Nonprofits spiral up or spiral out of control if finance committees and the financial function don't get the job done, though most nonprofits sort of end up somewhere in between. So let's go to the first slide. Next. Finance committees are key to strategic and operational decision-making that define mission success and impact over time. Finance committees say yes or no to new initiatives, expansion and replication, innovation, new space, current and future leadership, immediate use of financial resources, or delayed use of resources. Key organizational decisions are more and more subject to a set of financial short and long-term criteria. No longer do responsible organizations move forward without understanding the short and long-term financial ramifications of their decisions. This needs to be especially rigorous if financial resources are limited and if programmatic aspirations are robust. While these decisions transform nonprofits, finance committees must also be the source of operational and strategic rationality while understanding risks involved. One finance committee that I worked with set up a subcommittee to identify all the short and long-term management and financial risks and prepare for them depending upon the probability of occurrence and also depending upon the magnitude of impact if they did indeed occur. They set up an X and Y axis to make these determinations. I also find that finance committees are more inclined, for whatever reason, to take control of nonprofit financial reserves, primarily unrestricted, especially if they have established a board-designated reserve. I'm not quite sure how many of you have these, but more and more have them, and more they're designating them. This can be considered necessary. A board-designated reserve can be considered necessary if nonprofit management is considered to be profligate spenders, uncaring of the bottom line, a much less likely possibility in today's world. However, this becomes a question of control, designed to tamp down or restrict mission investment or spending. In other words, the finance committee could assume that they know more about how to run the organization than those in management. Those in management who in reality better understand the mission, the business model, programmatic goals, and just how the whole thing works. Nonprofit management, even experienced, have been hamstrung by the unwillingness of nonprofit finance committees to part with any of their unrestricted reserves or surpluses. It's as if the finance committee considers these reserves their money. It belongs to them. Every crumpled dollar belongs to them. Unfortunately or fortunately, this question of financial resource control impacts the corporate culture. The CEO, CFO, and management team are often forced to build their budgets from an austerity perspective, taking some financial resources and cash off the table. For example, expense reductions manifest themselves in lack of salary growth, which creates a culture of penny pinching and fear of thinking big. This can take a toll on morale, staff, and leadership drive, ability to expand impact, and of course, ability to attract top talent. Conversely, access to reserves can fund innovation, growth, focus, paying staff for their innovative efforts, and attracting and retaining top talent, critical to differentiating nonprofits to other nonprofits, their competitors. Don't forget the impact on finance departments of cash-obsessed. Don't forget the impact on finance departments if cash-obsessed finance committees demand accountability for every tiny transaction. The amount of work that's required to keep finance committees abreast of every single transaction oftentimes takes so much time that it really limits the ability of the finance department to do everything else it needs to do. Finance committees can bring a number of good ideas to the table. They should be able to discuss access to capital, to fund operations, capital campaigns, and fixed assets. They should emphasize the importance of leadership at all levels of the organization. I think they also can be quite helpful and conceivably innovative when strategic corporate issues are necessary to move the organization forward. Oftentimes, finance committees have strong experience with financial institutions, investment managers when they aren't their buddies, real estate people also when they aren't their buddies, and finance committees of other firms. It is not unusual for finance committees to focus on mergers, collaborations, and a review of other organizational financial statements to determine how 2 or 3 companies can work together. The finance committee should bring expertise and experience to replication, significant growth versus incremental growth, mergers, spin-offs, and large, substantial strategic moves. Next slide. Given the importance of finance committee decisions, they must work with the finance team to provide an overall financial strategy going into the fiscal year. To get there, the finance committee must understand the current and the future organizational financial position in the context of the years that went before them. In other words, the budgetary strategy and financial decision-making perspective can depend on previous year results. The organization that enters the current fiscal year with years of debilitating unrestricted deficits, reducing their unrestricted reserves to existential lows, needs to consider a break-even budget or one that runs unrestricted surpluses. Likewise, years of unrestricted surpluses may allow for a more assertive implementation of a strategic plan that invests in new initiatives and leadership the times allow for, if not required. Timing is all important. Finance committees and the finance team need to come up with a strategy to approach the fiscal year and beyond. The finance committee has to be involved in the strategic direction of the organization, not just how to fund it, but what are the ramifications of all the choices involved. The finance committee and finance team have to outline short-term budgetary fiscal year goals, such as departmental focus, covering direct and/or indirect costs on a program-by-program basis, increasing or decreasing the indirect cost rate, running surpluses to build reserves, spending reserves for the fiscal year wish list, and/or long-term investments in the name of financial sustainability. Questions of affordable additional debt, especially if fixed assets are required, are relevant to the long-term financial strategic arc. Given the financial and mission goals, the finance committee and management have to connect the dots. Financial goals must be aligned with mission, aspirations, and drive. If they are not aligned, either the mission won't be achieved in the long term, or organizations won't have the financial resources to optimize the organization's impact. Next slide. As nonprofits go about their strategic and operational business, all parties must understand their role and expectations must be clear. Expectations that don't match reality can lead to bickering and obsessing on political or controlled turf, ultimately ceding organizational initiatives and opportunities to other more focused competitors. My sense is that the optimal role of finance committees has changed over the years. It used to be that fiduciary responsibility meant hanging on or preserving unrestricted net assets, putting them all away for a rainy day. Mission investment would be paid for by someone else, foundations or government, a more measured and cautious approach to the future financial organizational trajectory. When financial problems arose, finance committees turned to cutting costs, especially administrative costs, to improve their financial position and redefine their business model. However, today's nonprofits, including the finance committee, need to be more focused on financial independence to better control their own mission destiny. Therefore, the notion of thinking long-term, investing strategically, impacting the statement of financial position and statement of financial activities to evaluate organizational strategic choices is necessary. This requires a focus on an investment in the revenue side of the equation. Finance committees are also responsible for evaluating the senior financial management team. Just as the board plays a role in evaluating the CEO, the finance committee should play a leading role in evaluating the CFO and other financial leadership. It is at the beginning of the fiscal year when expectations and goals should be made clear. This process also helps the CFO understand their responsibilities as the year goes forward. The finance committee must expect that they are budgetary partners in the process. Good and expected questions are part of that partnership and of expectations. Some of my favorite questions as chair of finance committees are, what does that mean? Explain the variance and impact on the fiscal year. Why are we running deficits? And what are you going to do about it? Give me the top 3 reasons we are doing well or not as well. Did we achieve our financial goals? What is the long-term story I should tell the rest of the board, especially if I have to report out to the whole board? And of course, at times, a good goes a long way. And just an hour ago, I had another example of what this role looks like. I got a call from the CEO of an organization on which I'm the chair of the finance committee, and she called and said that the CFO has just spent the weekend or so much time putting together something called a CFR, or financial report for the state. And she wanted me to call him up and tell him how much we appreciate his good work and how important it was to the organization. This is a task that I gladly do, but it's part of my responsibility, especially when you have a CFO that's gone out of their way to do their job. Next slide. When finance committee's fiduciary responsibility has expanded to include strategic mission focus and investment, more is expected of the finance team. The finance team must establish trust in their accurate and timely reporting. Those of you who are new CFOs or changing jobs know that even in good organizations, little strategic happens until the numbers are trusted. You often hear people say it'll take 6 months to a year to get to the good stuff. If the finance committee can't trust the numbers and they feel they are flying blind in trying to approve budgets, make decisions, or approve of CEO initiatives, decisions aren't made and opportunities are lost. Finance teams must then know how to present and use the numbers. It is expected that in addition to providing variance analysis, why are there differences larger or smaller than budgeted or anticipated, they have to craft a story that explains the numbers. For example, an increase in salaries may be due to program expansion and covered by increased revenues. Likewise, while reduced salaries may sound good, high turnover may preclude the organization from achieving its programmatic metrics. Finance committees may have trouble understanding that reduced salary costs on cost reimbursement contracts are not necessarily a good thing. First, the amount the nonprofits can vouch for is reduced, but also indirect cost recoveries are also reduced, impacting the organizational bottom line. This is a story that I have often had to explain on both sides of the aisle. Stories requesting organizational financial investment have to be compelling to the finance committee in order to make it into the budget. Financial management has to prioritize the investment and budgetary choices, play out the financial and mission results, and make clear what the impact will be on the financials over time. Scenario planning has become more and more of an expectation by finance committees on their finance teams. All this is part of an expectation that the finance function is not just, and financial leadership is not just a passive player in the financial drive forward. Whatever financial position the organization is in, the finance committee expects the finance team to be proactive with well thought out options, an understanding of the trade-offs, and an ability to understand the impact of the decisions on the future. Next slide. Each component of the financial function team, including the finance committee, must be made up of the right people. Finance committee should not be made up of a slew of investment bankers who don't have a clue about what the organization does or even why, despite their great connections to other wealthy people similarly mission challenged. And I say this with all apologies to those investment bankers that actually spend the time to learn the mission. The diversity of the finance team should also be reflective of the mission aspirations. There need to be nonprofit budget experts, those familiar with and experienced with government and nonprofit business models, lawyers, yes, even lawyers, entrepreneurs, nonprofit executives, users of the organization's services, and researchers on the finance committee. All need a commitment, have to have a commitment and a passion for the long-term sustainability of the business model. The makeup has to also align with the aspirations and goals of the organization. If you want to expand or replicate those from other regional jurisdictions may be necessary, as well as those with experience with spinoffs. The biggest pitfall in a finance committee is the domination of a single committee member with unrelated financial skills in a completely different financial world. This can set the finance committee and ultimately the organization in the wrong direction. Thought has to be given to the chair of the finance committee. They must be someone the finance team and the CEO can trust to support their compelling case or ambitious fiscal year budgets. The chair must convince other finance committee members that management has made a compelling case. Strong communication skills are necessary, and all should be prepared to offer and accept constructive suggestions. Limiting the number of arrogant members on the finance committee should also be a priority so everyone can work well together. Likewise, the finance team has to have the sufficient infrastructure and leadership to work closely with the finance committee. Don't skimp on the transactional folks, but also don't skimp on the financial function leadership. The entirety of the finance team has to understand the importance of mission success and producing and distributing the financial reports on a timely basis. And there should be enough staff to make sure that happens. That's very important. Finance teams should err on the side of robust financial function infrastructure. The opposite choice will cost significantly more given a harried and understaffed financial function. This includes the ability and time to work closely with the programs and with development to make sure everything operates in a timely fashion and financial goals are met. I can't underemphasize the importance of making sure that the infrastructure is in place to get the job done and keep the trains running on time. That is a compelling case. Next slide. Interaction with the finance committee should not be limited to strictly the finance team. The CEO is spending more time with the finance team and ultimately the finance committee, putting together budgets, financial and business plans, as well as strategic plans that need finance committee approval. Finance committees will in many ways defer to the CEO as to organizational and program and mission priorities, but need to be convinced there's financial backing to make programs work. CEOs who don't put in the time to get that right put their programmatic agendas in jeopardy. CFOs should make sure that they make it clear that CEOs need to spend the time to put their financial goals in place and understand what they are. Finance committees are taking a more assertive role in wondering why program departments aren't covering direct and indirect costs and expect answers from the CEO. ANSI finance committees often suggest cutting programs that aren't making money. CEOs have to be strategic and push back if necessary, given their programmatic agenda. Finance committees are holding CEOs responsible for the unrestricted bottom line. Deficits must be explained and analyzed, and CEOs are accountable. Program staff are valuable players in helping organizations achieve their financial goals, whether they keep costs in line, build realistic budgets, don't overspend contracts, find new additional revenue streams, build indirect cost rates into their grants and contracts while fulfilling their mission metrics, understand allocations, code correctly. The program staff can be the finance team and ultimately the finance committee's budgetary best friend. However, if none of the above happens, they can be their worst enemy. CFOs get fired for their inability to get along with the program team, especially if the CFO ends up in a silo, unable or unwilling to communicate with the program team. Likewise, it is the same with the development staff and leadership. If an organization needs unrestricted or restricted net assets, they need the development capacity to make that happen. In my case, I made sure everyone got the point by starting a development department at the Vera Institute of Justice. We needed unrestricted net assets, so we started the whole thing and hired a director of development at a mid-level, not at a top level. And it worked. Finance committees should expect that financial sustainability comes from growing revenues, not just cutting costs. So how to invest in development and revenue capacity should be high on their list of building business model departmental partnerships. Next slide. Finance committees, sometimes in conjunction with financial, executive, and programmatic leadership, need training to prepare for the upcoming fiscal year and beyond. There are different ways to do it, but what needs to be addressed is an understanding of nonprofit financial accounting and generally the mysterious reasons behind it. My methodology was to get together the finance committee, senior leadership, often separately, and go over the audited financials. I tried to connect each constituency to their impact on the bottom line and organizational goals. And believe it or not, those with an open mind were very interested, especially when their impact on the financial statements and bottom line was positive. I also discuss the business model with them. Where do revenues come from? How does the organization spend its money? And how to achieve financial sustainability and questions that inform decision-making. Explain everything to them and be transparent. Don't hide anything or shirk difficult questions. Building a relationship between the committee and financial management requires a set of structured questions expected to be asked at any point. Finance committees are known to ask the following questions more than once. What are the programmatic, administrative, financial, and strategic goals for the fiscal year? How are they incorporated into the budget? What revenue streams are not included in the budget? Are there contingency plans in place if revenue targets are not met? Next slide. A focused approach to finance committee and finance team engagements requires structure, protocol, and areas of anticipated resolution to questions. Reinventing the finance committee meeting every time is not optimal. There's often a great deal of discussion and concern revolving around the reports the financial management team needs to provide the finance committee. Finance committees and finance departments sometimes disagree as to what these reports or key metrics, such as unrestricted deficits or surpluses, should be. All parties should meet and determine a standard set of reports. I tend to emphasize fiscal year forecasts and therefore suggest the following reports as the bare minimum. I also emphasize that variance analysis is integral to understanding what the reports mean. The reports I recommend are the P&L, the annual forecast for the organization versus budget, including the impact on net assets, the P&L annual forecast by department, and also including functional expenses, cash, both cash position and cash flow spread out over the course of the fiscal year. And this includes anticipated and aged accounts receivable. And notice that the last report, monthly budget versus actual, is it necessary for the finance committee? I asked the question whether the monthly statement of financial position is necessary to report to the committee. Others may disagree, but here's my thinking. Budget to actual numbers are good internal reports for the finance and management team to analyze and use to put together the fiscal year forecast. There tend to be numerous timing differences, such that monthly budget to actual reports can often be misleading and do not provide the financial data to make timely financial decisions. To delve into the quagmire of budget to actual numbers at a finance committee meeting is to take away from the bigger picture financial issues that need to be addressed by the committee. However, as chair of the finance committee, I do expect the finance team to base their fiscal year forecast on the actuals to date and to be thoroughly versed on the underlying numbers. Next slide. For those CFOs who have done an excellent job in producing accurate financial statements on a timely basis, and finance committee members who trust those numbers, it still is not enough. I always say that CFOs spend less than 2 to 4% of their time with finance committees, but it represents close to 50% of how they are perceived and evaluated. To that end, CFOs and their team must analyze reports, explain variances, and put them in fiscal year and business model perspective. The finance committee should expect it. Likewise, finance committees cannot just sit on the information and not react. They must be proactive to turn the financial position and forecasting into forward-looking and key operational decision-making. It is critical to prepare for each finance committee meeting by anticipating questions, most relevant, but some coming out from left field, from committee members with an unknown agenda, or over time, a known agenda. The question you expect the finance committee won't ask, they will ask. Take an hour before the meeting to go over the possible questions, even identifying the committee member and what questions they might ask. As a finance committee chair, I always ask what's going to go wrong and what's going to go right. Before getting to the questions, it is necessary to lay out the financial story in advance of the meeting. For simplicity's sake, let's call it a budget narrative. The financial narrative would be sufficient. This is basically a written report or memo. I call it a treatise that addresses the financial budgets, goals, results, contingencies, opportunities, perspective, and ultimately focuses on the challenges ahead, big and small. Remember, there should be no surprises. It also makes a compelling case for budgetary decisions made or to be made. A conversation with the chair of the Finance Committee before the Finance Committee meeting is also very important. If they are in alignment with management, it'll be easier to get the votes and support to move forward. This is especially important if the fiscal year budget is going to represent a deficit, even for good reasons. I generally also insist that the CEO attend the Finance Committee meetings and expect them to lead the first 5 minutes discussing mission success, often translated into communication success, as well as meeting program goals and aspirations. This tends to put the Finance Committee in the right mood to move the organization forward, as well as to get excited about the organizational accomplishments. Finally, all involved need to have respect for the organizational nonprofit finance function and reject the notion it is a lesser corporate structure. Otherwise, finance committees can be dismissive of management suggestions, their good ideas, and dream of the for-profit sector, which doesn't always have their own sterling track record of profitability and business model success. Next slide. There are some key issues which transcend fiscal years, but can determine the eventual financial trajectory of the organization. Finance committees can be consumed with cash as a measure of organizational financial position, not realizing that FASB dictated accrual method of accounting determines cash flow over time. Finance committee panic sets in even when liquid resources such as unrestricted reserves, unrestricted board designated reserves, lines of credit, various bridge loans, delayed receivables which require attention are available. Unless the organization is in extremis, down to their last cent or running big deficits, the impact of this cash traumatized or obsessed finance committee has been known to reduce salaries, postpone payroll or vendor payments, spur leadership departures, reduce staff morale and turnover, and ultimately reduce the probability of program metrics being achieved. I've seen finance committees postpone programmatic investments that are directly tied to increased funding for successful programs. The lesson is, don't take cash off the table at the expense of programmatic success. Financial and mission goal confusion is often on display given the decision to invest in new space, buy buildings, or other fixed assets while taking on debt, sometimes significant. The desires of the donor naming new buildings after themselves can be at the expense of the core programming. Bringing on significant debt for a named, partially paid building can not only suck the life out of all operational donor efforts, but it can preclude long-term programmatic and strategic investment. Likewise, the financial management of the organization has to be realistic about its priorities and the impact of the fixed asset financial decisions on the long-term business model and expense structure, especially if they can't be billed to grants and contracts. One organization's finance committee approved a capital campaign to cover uncovered space costs. Good for the operational bottom line, but perhaps a capital campaign or a buildup of unrestricted net assets that really was an opportunity that was missed. For those organizations with unrestricted and restricted net assets that are part of an investment pool, spending rate can dramatically impact financial sustainability. In an organization where I was CFO, we had a full-day retreat on the spending rate. It was between 7% and 8%, but it allowed for the organization to fulfill its programmatic needs and goals. The Finance Committee was convinced that 5% was the necessary cap to preserve principal over time, though it never was clear what it was being preserved for. The compelling argument that the finance team and executive made was that by using the increased spending rate, the organization was programmatically stronger and ultimately more attractive to clients, funders, donors, grants, and contracts necessary to build long-term revenue streams. And actually, this was the case that the Finance Committee ultimately agreed to based on the compelling arguments of the finance team. Next slide. More and more mission investment decisions play out during the annual fiscal year budget process. These investments ultimately over the long term distinguish between less motivated nonprofits remaining on a financial treadmill, there's that word again, and those that progress. If there is a measurable financial and programmatic return on mission investments, the financial and programmatic leadership team need to make that compelling case. The Finance Committee will weigh the benefits and risks, but should be prepared to take management's advice on whether to move forward or not. Interestingly enough, some finance committees have taken a more proactive approach to mission investment and will actually ask, especially if the organization is forecasting an unrestricted surplus or has sufficient reserves, what investments can or needed to be made to achieve the mission over time? What do you need to grow and invest in the organization? Finance committees are asking that question. Finance committees and management have pushed for investment in research and evaluation, ultimately looking at impact, program growth or innovation, development investment, including expansion, or even a threshold investment to establish a development department, technological investment, as well as organizational leadership. Next slide. Ultimately, training, education, and goal clarity make up a finance committee and finance team leads to managing several key processes over the course of the fiscal year. These processes require the teamwork of the finance committee, CEO, and financial management to be successful. The finance team has to negotiate with the finance committee the products of each process and the expected results. A key result for the audit process is to determine not only what happened in the past, but what does this mean for the future? A key question for the fiscal year forecast is how often is the forecast necessary, and to what length should the finance team go through to prepare one? I usually prepared one for each finance committee meeting, usually quarterly. The first forecast was more anecdotal, especially as it was at the beginning of the fiscal year. It focused on anecdotal significant threshold amounts that impacted the budget. Say anything that had an impact of $5,000 I would include, or $2,000, depends on what the size of the organization, I would include in the budget. The second, around mid-year, was a much deeper dive with significantly more interaction on a line-by-line basis with program, executive, and the development team. The last was a combination of the two. However, a lot depends upon your business model, how nervous your finance committee may be, and frankly, new technological reporting capacity makes the forecasting process easier. Next slide. The whole finance team has gone through the fiscal year and now must evaluate the process and accomplishments. How did the team perform? Everyone wants to know, what did all our financial thinking, strategies, decisions, results, forecasts add up to? What financial goals were there at the beginning of the fiscal year? What program or strategic goals were achieved over the course of the fiscal year? Is the organization on the right track to be sustainable? Criteria set up at the beginning of the year will make this process manageable, effective, and something everyone will learn from going into the next fiscal year. Next slide. So now that everyone has figured out what worked, what didn't, my recommendations are pretty basic. I don't really think they're best practices to fulfill the promise of an enlightened, self-actualized finance committee, finance department team relationship. My most relevant thoughts are to ensure that your own unique nonprofit finance committee, CEOs, and finance team relationships are driven to achieve similar goals and results. If that isn't clear, and if you aren't talking, start talking. Hang out together at organizational events. Get to know each other and what drives everyone about why they're involved in the organization and the organizational goals. Despite this informality, also feel free to formalize or continue to formalize the interaction between the finance committee and the finance team. Ultimately, for all the financial function team, including the players cited in this presentation, togetherness will achieve mission and financial nirvana. If any of you have actually achieved mission and financial nirvana, I hope you express that in your questions or your comments. That will certainly be relevant to the next presentation. Next slide. Do you have any questions? Does this make sense? Is this relevant to your experience on finance committees as part of a finance team, the interaction between the two? Again, I've sort of taken a sort of proactive and strategic role to this relationship because I think that's the key to making it work and pushing nonprofit organizations forward. So Melissa, I turn it back to you, and if anyone has any questions, I would be delighted to answer them.
Yes, thanks, Russ. We do have a couple of questions. First of all, just a reminder that we will be sharing the slides and the recording of this presentation afterwards. You should look for it in your email inboxes tomorrow. We do have a question. How often do you recommend finance committee meetings?
Good question. Usually I think there's about 4. One, it's the beginning of the fiscal year, so near in September or October, and that's usually to kind of go over the audit and sort of make clear what are the key issues that everyone's going to be facing over the course of the year. The second is sometime around, this is assuming your fiscal year is July 1st to June 30th. The second is around January, where you go over much more rigorous forecast that I outlined. The third is generally around March and April, where you continue to follow up on how the year is going, and if there are any more decisions that need to be made, what they are in order to achieve your financial goals. And also at that meeting too, I think what's key is to start to lay the groundwork for the fiscal year budget. What are the challenges? How do you perceive, especially what are the goals given like the context of the current fiscal year, given context of previous fiscal years? And also this is the time to start talking about programmatic aspirations. What are you trying to incorporate into the fiscal year budget that is then presented in June? And in June, you present the budget. There may be some discussion about the forecast for the year, but pretty much the year is over. There's usually not much you can do. But again, what happened in fiscal year 18 that helped you determine what the fiscal year 19 budget was going to look like? And I think what's key in going into the fiscal year 19 budget is explaining all your goals and how your wish list, your investments, and how they were worked into the budget, what you included and what you didn't include, and where you want to end up in the next fiscal year. So that's why generally there are 4. Again, different if there are issues or problems, or you're not achieving contingencies, then maybe you want another one. Or what you can do instead of that is have a conversation with the head of the finance committee, and they can determine whether they need another finance committee meeting.
Perfect. We have a few more. We have a full board, yet no finance professionals on our board. How does the finance team communicate with a finance committee that has no understanding of what they are hearing?
Well, you've got to get a finance committee that understands. So I guess there are a couple different options. First of all, the finance team has to explain to the CEO that you have to have people on the finance committee that understand what's going on. And the CEO has to communicate that to the chair of the board and make decisions as to how to build finance capacity on the finance committee. There are a number of times when I've had this conversation with CEOs and sometimes also with the head of the board and said, look, this is what we're trying to do. You're not going to get there if you don't have anyone on the finance committee that can't figure out what we're trying to do and evaluate the finances of the organizations. If you don't have that, bad things are going to happen, and bad things have happened. So as I said, you've got to make the compelling case to the CEO, to the board chair, and in addition, as I said, you have to be prepared to start training whoever ends up on the finance committee. And you'll want several different people on the finance committee that have capacity. The thing you don't want is just one person who knows, because they tend to have their own agenda, and oftentimes they push through a conversation or a perspective that can be limited. And you really need a much broader sense of nonprofit organizational finances and your specific budget and goals. I hope that's helpful.
All right, the next one is it appropriate to offer a small stipend for finance committee members?
I wish. I don't really know how that works. Maybe that's a legal question. I don't know how much would motivate someone to be on the finance committee or not be on the finance committee. None of the finance committees I serve on have made that offer. I think it's the opportunity to be with an organization that's going somewhere and not on a treadmill that really provides the drive and interest to be proud of the organization you're involved with. So my sense is that you don't need it. It shouldn't have to end up that way. There are enough people out there that should be able to provide that kind of service, who are interested in pushing the interest of the organization forward. You know, I don't really know legally whether it can be done or whether it can't be done. It may be done in some places, but that's not necessarily the way things have to be.
Okay, so the next one says, on stipends, we provide lunch during our meetings. That seems to be incentive enough.
Lunch during meetings?
Yeah.
Sure. What do you serve? I'm not sure. So lunch as a way to get people on the finance committee meetings, or?
That's what it sounds like. She's saying we provide lunch during our meetings. That seems to be incentive enough. I think that's a response to the question about stipends.
Okay, yeah. Well, I've been on finance committees where they've had really good lunches. I've been on some where they're not so good. But the fact that there's lunch definitely is a plus. Lunch and breakfast too.
So, Russ, we have another question. One is asking, when is the next time you'll do a similar webinar like this? And I'll answer for JMP and say that we haven't scheduled anything yet, but I wanted to give you a chance to see if you had any upcoming webinars like this.
Do I? No, I don't. I'm glad to do them. I think this is a topic that people haven't really focused on, and I appreciate the fact that you and JMT have allowed to do this, because as I said, and so the hypothesis here is just this has turned out to be the finance committees and their assertive strategic role, along with the sort of strategic role of the finance team, make a difference as to the ultimate mission impact of the organization and the financial trajectory of the organization. So I'm not sure when my next conversation is, but I'd be glad to have any conversation with anyone or any group, or follow up on this as well.
So it looks like we don't have any other questions as of right now. And we'll give people another minute just in case they have a few more. Russ, who is the ideal candidate for a finance committee?
Yeah, that's a good question. Again, so much depends upon what the organization wants to do and where it needs to go. And someone who can connect with that mission and not only understand the underlying financial numbers and trust those numbers, but someone who understands what the investment needs to be to grow that mission and push that mission forward. So again, it could be, someone who understands, depending on what the organization wants to do, replication, spin-off. It's someone who understands mission growth. It understands, key strategic decision making. They understand, if they're looking for much more of a leadership capacity in the organization, someone who's got human resource experiences at the top level. Space is often, someone who has experience with real estate if the organization is looking to relocate, and how that all connects back to the finance team. So they've got to combine an understanding of organizational finances, nonprofit organizational finances, with understanding what's necessary for the drive forward. And it can be any number of different people, any number of diverse cultures, walks of life. You need people who are flexible, think flexibly, who are curious, ask good questions, but are committed to that drive forward.
All right, we have one more question, and then I think we'll be close to wrapping up. What is the ideal size for a finance committee? Is there such thing as a committee being too large?
That's a good question. Yes, I think so. If it's too large and everyone defers to everyone else, and they don't get anything done, then it's too large. If it's too small and you've just got a couple people with their own agendas, that's too small. Committees of anywhere between, I'd say, 5 to 7 often work. Again, especially when everyone understands, their role and understands what they should be thinking about and why they're there. So somewhere around 5 to 7, I'm guessing, would be a good size. So that's my guess. Again, sometimes you can get away with 4, but usually someone doesn't show up at the meeting, and then you're down to 3 or 2, and you just don't get into the meat of the issue.
Wonderful. Thank you so much, Russ. I think that's going to conclude our questions. So I want to thank everyone for joining us today, and thank Russ for his time. We hope you enjoyed the presentation and that you'll join us for future events and webinars. You can find our upcoming webinars and events by visiting us at jmtconsulting.com and clicking the Events tab. That concludes our webinar, and I hope everyone has a great day. Thank you.
Thank you.